we have the highest quality brands when we close on this deal in the U.S., and they're also low priced. We'll have 20% of the viewership, and we'll have about 8% of the money. Sports, on the other hand, gets a multiple of what. So we're a great buy for distributors. And today, the only thing that if you're a college student, you could subscribe to cable, or you can get Netflix for $8.99. Well, we could put together a skinny bundle, together with other programmers or other distributors. That is, as I've been saying for a long time, that's $10, $12, $15.
As long as it doesn't have sports in it, you're fine.
Right, but if you look at the skinny bundles around the world, this is the only country that has sports and retrans stuffed into that. So eventually that will rationalize. The other thing...
Does the revenue number stay the same? Can you really grow, though, as that entire ecosystem changes to that extent and you end up on a lot of these skinny bundles? Does A equal B? From the, A in the new world equal what B used to be in the old world?
Well, there's two objectives. One is to be on every platform. Be in every bundle, be on every platform, be on every screen. And the second is to figure out how to monetize it most effectively. And it's going to be a mix. Some of it is going to be B2B. It's going to be through the skinny bundles or through an over-the-top bundle. And some of it may be direct to consumer. That's what we're doing with sports in Europe. And our pivot has been about not just content that people want to watch when they could watch anything, but what do we have that people will watch when they can choose anything? And what do we have that people will pay for before they pay for dinner? And that's why we've invested $6 to $8 billion in sports, and we're the leader in sports in Europe. That's why we invested in kids in Latin America. And when you look at the affinity groups behind home and garden and food and cooking and DIY, those could be very deep verticals. I mean, Ken has been a leader in doing this, but together as a larger company, and the analytics that you get from knowing who all those people are and having them consume the content and being able to bring, which Scripps has done brilliantly, bringing in the advertisers that want to reach them and having them be in for a premium to play in that space has been very, very economically effective.
Ken, Viacom competed aggressively here. I'm saying that, you don't have to, but I'm curious, when you were making a decision about whom to sell the company to, was it only price? Why not Viacom? Why was it Discovery?
Well, I'm not going to, as you said, I'm not going to speculate and speak on anything that may or not happen in the past, only focusing on the future. The real reason we're here today talking about this merger, as I said at the top, it's great for our shareholders. This obviously was approved by the Scripps family. It puts the Scripps family now back in business with John Malone, who they owned cable systems with years ago, with the Newhouse family, who they were partners in the newspaper industry. And also, at the end of the day, the family, like me, believed this was the very best home for our employees, the opportunity for our employees and our brands. To do things with them, quite frankly, we would have challenges to do based on the fact that we just don't have the international infrastructure. So if you combine all of that, it was not only the best deal, it was the best partnership.
The thing that makes this really attractive to us financially.
Yes. Okay, go ahead, because I was going to, let me ask. Okay, synergies.
The synergy,
$350 million is the number you're using. Frankly, a lot of people think it's low, David. It's got to be a key driver here of the value.
We think it's low. It was we did a short diligence period, and that's what we have our hands on now. It's a 1-over-1 company. We do a lot of the same things. But when we look at this, the thing that's really attractive is not just the cost synergy. So when you put in this cost synergy, and we think it should be higher, we're buying this company for our multiple.
Right.
That doesn't include the revenue synergy.
It lowers the adjusted EBITDA multiple. Right. Although, frankly, investors don't seem that enthused. Your stock's down about 6%.
We're enthused. What's really exciting about this for us is we think there's more cost synergy. More importantly, there's great revenue synergy opportunity for us. This big strategic value. And as I said, we may be the largest IP storytelling content company in the world.
You're not going to spend as much money as Netflix on content.
Well, we're going to spend about $3.5 billion on content. But after we acquire this asset, a year and a half to 2 years later, will be an enterprise value, if it's about where it is today, of $40 billion. And we'll have a balance sheet where we're levered less than 3.5 times. And we'll have real flexibility with that balance sheet to invest in more of our assets or to go out and buy more stuff that we need so that we come out of the terminal tunnel. Who's going to be the big winners? We think with this IP, together with their creative team, everything
really repositioned the company for the future today with this deal.
We think we have, and we couldn't be more excited about being in business with Ken.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.